The real estate market downturn is expanding every single month across the country as more counties go down in price. Let's dig into what is going on and what is causing this across the board so you can make the best decision for you and your family and your real estate investments. Now, this is the key chart that we really want to dig into. This comes from Reventure Consulting. This is house payments as a percentage of median income. Now, there's something called the rule of 28%, which is basically saying this is the standard where you don't want to spend more than 28% of your median income on your household payments. Well, right now we are all the way at this next peak in 2024 of 39.4% over here. The first bubble that we had in 2008 was a 38.1%. So when we're looking at house payments as a relative indicator to median income, we're already past these levels of the great financial crisis and the bubble that we had in that time period. For us to get back to this 28% rule, we need to see prices come down 30 to 40%. Now, my personal investment models show that we need to see prices come down between 31 and 42% for financial investments in real estate at the values that they are today to make sense to buy and hold a real estate asset. This is important because there is a backstop to real estate where if prices come down, if rents stay at a certain point, it makes sense for us to continue purchasing real estate at that price. Of course, that also depends on where mortgage interest rates are, which is the major factor that's caused both of these housing bubbles. Housing bubble number one was just obviously ninja loans, just giving loans to everybody humanly possible. Housing bubble, and that started with Greenspan, expanding home ownership, et cetera, et cetera. We all know the story there. This housing bubble was just completely caused by 2020 time period and the zero interest rate policy that the Fed adopted, which just caused people to rush into the market. Not only institutional investors, but mom and pops to go out there and gobble up 3, 4, or 5 properties, including Airbnbs and all these speculative investments that they thought the market would continue forever. Well, now we're starting to see that this market has stalled out and that prices are actually starting to come down across the country in specific areas. So this is a great chart as well to just show more cyclically what is happening with U.S. home prices. These are inflation adjusted home prices. You can see the 2006 bubble, and now we're in the 2005 bubble, which on an inflation adjusted basis, we are way beyond, again, the peak of the 2006, 2007 time period. This is what is causing the affordability crisis and locking out the next generation from their ability to be able to purchase a home. But not every market is reacting exactly the same. Why? Because real estate is regional and it is also micro. The areas that saw the largest levels of speculation are the ones that we are starting to see the market continue to move down. We're also seeing migration patterns abruptly change directions, which caught a lot of home builders off guard. And now we're basically seeing the home builders suffer and just slashing the prices on their properties to get them sold and get out of their positions because they thought that migration would continue to move forward. So let's see. We see Austin, Texas, Tampa, Miami, Orlando. So a lot of Texas. Here's Jacksonville, Florida. That's where I am. A lot of areas where there was wild amount of speculation, institutional investors, mom and pops, gobbling up as many starter homes as humanly possible, jacking up rents for people, making it really unaffordable. These are the areas that are now losing prices. Look at this. And of course, this is just the average for that specific city, but there's specific markets in each city that are doing much worse than the average. And I think this is important to mention because there's areas of Jacksonville that are only down 5%, but there's other areas that are down 20%. So it depends on where you are, how close you are to new construction, and the amount of multifamily new construction that's coming onto the market. Meanwhile, you can see in Connecticut, Ohio, New York, Illinois, these areas are still appreciating. They're appreciating about the normalized rate. We like to say about 3 to 4%, right? That's what's traditionally set out there. That real estate appreciates. However, those are starting to slow as well. This data comes from Resi Club, Lance Lambert, from December 2025. However, we are still seeing, I'm talking to top real estate agents across the country. Yes, they still show on paper that the prices have gone up, but they're starting to slow in their acceleration of that appreciation. So this is another chart that just shows that real estate is very regional. You can see here year over year declines in 2 regions, which is the South Atlantic and the West South Central areas. The Sunbelt areas are the ones that are slowing the most, but you can also see in the Northeast, In the Pacific areas, you're starting to see a little bit of an increase in the middle Atlantic. But you see in the United States across the board, when we just look at everything together, it shows 1.7% increase from last year. And the price change from 2023 to 2024 was 4.7. So we are seeing a deceleration in home prices across the board. I actually expect prices to be flat or negative across the board next year, slightly negative, as the market starts to continue to move down due to this affordability crisis. Here's a report comes from the FHFA. Here's a little segment that they said in here. So even though we were up year over year, 16 of 20 markets declined month over month in October, signaling a broad stagnation as high mortgage rates weigh on affordability and suppress price momentum. Well, we're at 6.12 to 6.18% in our rates today. And so that's not a very high interest rate. We could actually, if the government doesn't step in, we could actually see higher rates next year. However, I fully believe the government will step in. The Fed will step in and start buying mortgage-backed securities and treasuries to do anything that they can to bring down mortgage interest rates and continue to push the housing market because it has such a multiplier effect in the economy. So here's the chart that shows where we're starting to see the pain already. Most of them, 6 of the top 10 are actually already in Florida. Home values are falling in 10 major metros. This is according to Realtor.com. After years of record-breaking appreciation, the market is starting to come back down to earth in some areas where houses are beginning to lose value. Of course, right? Markets are cyclical. They go up, they go down. I think a lot of people are stuck in their heads that real estate always goes up 3 to 4% every single year. That's just not the case. You saw the chart earlier. You can see that it's very dynamic, and there's specific markets that are more boom bust in nature because of the speculation in those markets. That includes right now Florida and Texas, and Florida has always been a speculative market. So you can see Northport, Cape Coral, Lakeland, Tampa, Daytona. These areas are actually starting to see the year over year declines already, and this data is lagging. It will take time for the real data to start playing out. We're likely going to see more distress start to show up in Q2, Q3 of next year. That's where I believe there's going to be a wave of foreclosures that are a backlog hitting the market, especially here in Florida, that haven't been processed through since 2020. And obviously, this is a great chart that also is from Resi Club. It says change in metro level home prices since each metro's respective peak in 2022, right? So it was about August to October timeframe that we had the peak here in Florida for prices. And then the Fed's raising of the interest rates obviously moved the market downward, and there was stopped being a relocation from the Northeast and from the West to Florida. And now we're actually, according to a new B of A article that came out, their report basically said that we're near net migration to Florida at this point in time in the marketplace. And that migration is going to drive buyers. So if we don't have migration to the area, then it's going to be locals who are already priced out due to affordability. The inventory continues to stack every single month, which is causing prices to come down. So you can see Punta Gorda is basically ground zero. Cape Coral is down 18%. Naples is down, and Daytona Beach. And by the way, I still talk to people and they say Daytona is a great place. It's like, it's one of the worst. Okay. So it's very talking about their investments and things like that in specific areas. And perhaps they're doing well if they bought at the right time. But if they bought between 2022 and 2024, they're down on their investment in underwater. And if you include the closing costs to buy and sell that round trip cost, they're down a lot more than they might think. So this isn't a cooling effect. This is a down cycle that I believe we're going to see for the next 5 to 6 years here in Florida specifically, and in the Sunbelt areas where there was just a large amount of speculation. The Northeast, again, is a completely different market. You look here at Rochester and Milwaukee, their markets are up since the peak in 2022, and they just continue to drive forward. There's people relocating back to those areas. There's businesses there. They did not overbuild, and there was not wild speculation in those areas. So that is why they're not seeing what we're seeing here in the Sun Belt. And of course, this is a chart that came out from Compass. This shows Florida inventory is headed lower. Well, of course, during the end of the year, inventory heads lower. And there's 2 factors that are coming in. One is seasonality. This is typically what happens towards the end of the year. You can actually see it right here. In the prior year, it kind of dips a little bit, right? That is totally normal. However, the phenomenon, while you might see this as, oh, this is a good thing for Florida, we're seeing all this inventory, come down. That must mean things are starting to get better. It's not. It's actually the opposite. The reason why is because there's pent up supply. Sellers are listing their house. They're not getting the price that they want. And then they're getting upset and they're rage quitting the listing, taking it off the market. And they're hoping that they can get a higher price next year. This is unlikely to happen as more and more inventory comes on. The houses are sitting longer, the demand is waning, and affordability is only getting slightly better just because people are starting to slash their prices. So I don't think this is a good indicator. On the ground, we're seeing a very high level of expired listings, a very high level of withdrawn listings, and we expect this inventory to come back on the market in the spring. Probably February, March, and April of next year, we're going to see a rapid amount of supply come on the market here in Florida. And inventory from the same company, Compass, they're putting out this forecast. They're already expecting inventory to move up. It was 12% increase over the last year and another 10% increase in 2026. And this is how real estate inventory stacks up when we start to see prices come down. It's not an overnight thing. You can see the cycle. Real estate's very cyclical. And now that we've got this extremely low inventory that we had in January 2022, then we had the Fed hike its rates and we saw it starting to move up. And now we're at this period of we're just going to continue to see inventory move up until the government steps in and tries to lower rates again. And we might see the inventory start to level off a little bit. But they're expecting another 10% increase over next year. But ultimately, what's happening right now is that the U.S. turnover ratio for the number of homes sold, there's 27.7 homes sold per 1,000 homes in the first 9 months of this year. This is one of the lowest levels that we've had in decades, and this is a big red flag. Why is this happening? It's because 70% of homeowners are locked into these low mortgage rates that they refinanced or purchased in the 2020-2021 time period, and fewer selling because they don't want to lose that interest rates. And the next buyers can't buy because they can't do it at these prices and at these rates that we have today. So it's just a stalemate that's happening between the buyers and the sellers, and we expect this stalemate to continue. That being said, one side will give up, and it's going to have to be the sellers at this point because of the amount of inventory that's coming on and the demand from the buyers. So prices will start to come down across the board, not just in the Sunbelt areas, but in the Northeast and these other areas. The prices will start to decelerate, and then eventually they'll go negative over the next couple of years. That's my projection. The magnitude and timing and direction of these are very hard to calculate. I'm not going to guess. I'm just telling you directionally what I believe is going to happen in the future. When the fear sets in the marketplace and people no longer think it's a good time to buy, and it gets across the country and feels that way, that's when things will really start to accelerate. And people are already starting to go underwater in their houses. You can see this is from Google search. People just searching help with mortgage it's above the 2008 level already, which is crazy because there's a record amount of equity in people's houses. But the problem is the people who bought put 3.5%, 0% down, FHA, VA, low percentage down for conventional during these boom years, 2022, 2021, and we're basically going back to 2019 levels of pricing. And so people are starting to go underwater already, which is a big red flag. But the reality is Housing Wire's pitching that there's still a shortage of supply of housing. Obviously, they're incentivized to pitch this narrative to us because there are so many builders and title companies and everybody who sponsor their business, and that's how they make money from these sponsors. So just be aware that you're going to continue to hear this narrative that there's a housing supply shortage, and they're going to continue to push this across the board. Just be careful who it's written by and why it's being written for you, because they're, again, trying to get this narrative that there's just not enough inventory, so you continue to buy. But the reality is that new construction inventory is stacking. We're already at 2009 levels, the highest level of completed unsold homes since July 2009. And this is a huge red flag as this inventory continues to stack very quickly in a short period of time. Look at how fast it's moving up, just the same way it did last time. And so for people to say, hey, the market's still healthy, everything's great, and then you still look at this chart, obviously that is a massive red flag just staring us in the face. And imagine being that buyer who bought a Lennar home for $500,000 in 2022. I mean, this is an insane number. The average selling price has dropped from $511 all the way to $375, more than a 22% decline. And the new orders have moved up, obviously, because once they reduce the price, people are saying, okay, you're going to reduce the price, you're going to buy down my interest rate. And they're preferring this to existing homes. But I mean, honestly, the quality that we see locally of the Lennar homes is just not something we would ever want to be involved with. It's not looking good in that regard. And there's tons of lawsuits that might be filed in the future for these builds that they slapped up in a record period of time. So we're starting to see this drastic drop in price, and that's impacting all of the properties around these new construction communities. And the people who bought in the first phase, and there's multiple phases, the first phase people are immediately underwater when they purchase those homes. So yes, you do get the low rate, but then generally you're immediately underwater if you don't put a large percentage down. And the labor market is starting to crack. You can see a deceleration in the labor market for the amount of hiring. This is change in ADP, private employment. We see this across the board. We're already at great financial levels of layoffs announced. And so we're likely to see some distress coming into next year. If the labor market continues to crack, that will be the number one thing that will crack the housing market. So I'd love to hear what you're seeing. Do you think that the downturns will spread to other markets? Do you think now is a good time to buy? I'd love to hear what you think and what you're seeing. Drop a comment of where you're located and what you're seeing on the ground. I'm always learning from the people across the country, top agents across the country. And if you need a top agent for your market, let me know. I'm in touch with many of them, and we talk every single day. People are reporting, hey, this is what we're seeing. This is an example of what we're seeing. We're seeing more short sales. We're seeing more foreclosures spike, and they're describing what's happening. And then in the Northeast, we're hearing some people say, hey, it's been good for the last year, but we're really starting to slow. I think the affordability is finally catching on with the buyers here locally, and relocations are slowing and things like that. So love to hear what you're seeing on the ground. Again, I don't trust the media across the board. Sometimes the data is lagged, so you're not getting a full picture of what's going on, and things can change pretty rapidly in the real estate market, as we've already seen just in the past 3 years with the amount of supply that's come onto the market. As always, if you want to follow me on Substack, look for my link below. You can subscribe and get an update 2 to 3 times per week of what's going on. I also post all these charts on X. You can follow me at John Brooks. Would love to connect with you. And people already 7 million views there in just the last 30 days. So thank you guys for following there. As always, thank you for watching, and I will be in touch next week. See you later.